I was looking through my trade log from the last couple of months, and something caught my attention. Out of thousands of listed companies, I kept trading the same handful of stocks. That wasn't intentional. Every week I start from scratch. I scan the market again, rebuild my watch list, and only trade the names that still pass my process. When I ranked the stocks by how often they actually became trades, a clear pattern started to appear. Amazon became one of the names I traded most frequently. So did SOFI. IONQ kept showing up. More recently, Hood joined the rotation. ABNB came back several times as well. At first, I expected to find something obvious. I thought maybe they all paid the best premium. Or maybe they all belonged to the same sector. Or maybe they all had the strongest charts. None of that turned out to be true. They all stayed in my rotation for completely different reasons. Amazon is probably the easiest one to explain. I've never traded Amazon because the premium was exceptional. Most of the time it isn't. What keeps bringing me back is assignment quality. If I wake up owning the shares after expiration, nothing changes. I'm happy to own the company, and I already know how I'm going to manage the position. SOFI earns its place differently. It simply gives me more opportunities than most stocks. The options stay liquid, weekly expirations are available, and the stock regularly pulls back into support. It doesn't mean every pullback becomes a trade. Most don't. It just means SOFI keeps giving me another chance to evaluate exactly the same setup. IONQ is almost the opposite. The premium is much higher, but so is the volatility. That's why I spend more time looking at the chart than the option chain. If price is extended, I wait. If it pulls back into an area where I'd actually be comfortable owning the stock, then it becomes interesting. The premium is still attractive, but now the assignment price makes sense too. Hood is one of the newer names in my rotation. Weekly options and elevated implied volatility make it worth watching almost every week. The difficult part isn't finding premium. That's easy. The difficult part is waiting for price to come back into support instead of selling puts after a big rally. I've probably rejected as many Hood trades as I've taken. ABNB falls somewhere in the middle. It isn't always on my watch list, but when it pulls back into support, earnings are far enough away, and the options are priced reasonably, it usually makes it through the same process. Looking back at the trade log, I realized I wasn't really comparing stocks. I was comparing decisions. Every one of these companies had a different chart, different implied volatility, and different option premiums. But before any of that mattered, they all had to answer the same question. Would I be comfortable owning this company at my assignment price? If the answer was yes, I moved on to the next step. If the answer was no, the trade stopped there. The point of this video isn't to tell you these are the best wheel stocks. 6 months from now, this list could look completely different. The point is that these were the companies that survived the same process more often than the rest over the last couple of months. The market changes. Different stocks come in. Others disappear. The process stays exactly the same. You control the process. The market controls the outcome.